Good afternoon or possibly good morning, depending on where you're listening to us to from day. A special webinar that we have for you here from Advanta IRA today on the coronavirus. So we try to bring a lot of educational and timely topics to all of our listeners and to our database. And I think there's nothing more timely than the one we have today with our guest host, somebody we've had on several times here at Advanta IRA, Mr. Bawa. I'm going to bring him on in just a moment. For those of you who are not familiar, my name is Scott Maurer. I'm the Director of Business Development here at Advanta IRA. I host many of our webinars as well, along with some of my colleagues. Been with the company for a number of years. I'm also a licensed attorney, although I don't do any legal work on behalf of Advanta IRA. Here's my contact information if you need to reach out to me. Any questions you have regarding self-directed IRAs specifically, or just general IRA or 401k questions, I'm always available to answer those for you. So please call me or email me, however you prefer to do. A quick disclaimer, we provide this at the beginning of all of our events, that we don't provide any legal, tax, or investment advice. We don't endorse any particular products. We like to bring in guest hosts as well, like we've done today with Neal. But again, their opinions are their own, but we like to bring that value and bring that great information to you. So all of our webinars are always for educational purposes only. If you do have questions about an investment type or a strategy or anything we discuss in our webinars, we do encourage you to consult with your attorney, CPA, advisor regarding those. And if you need a referral to one, just let me know. We're always happy to give you the name of somebody in one of those fields who could help you out and get your questions answered. Just a quick note about Advanta IRA. If you're new to self-direction, or if you're new to Advanta specifically, we're a self-directed IRA administrator. We've been around for over almost 20 years now. We have over $1 billion in assets under management across the 2 offices we have here in the Tampa Bay area. Currently, we also have an office in Atlanta, but we do work with clients nationwide. Our differential, I think, between us and other competitors in the space is really our commitment to the customer service and giving people one point of contact for anything they need regarding their account. And we do so, again, through the offices we have in both in Florida and Georgia for people to come and sit down and meet with us face-to-face. But we do, even for people who are nationwide, assign you to one account manager who is your one point of contact for anything you need regarding your account. But we also are very committed to education, and we do that through our weekly webinars and seminars live. We bring in guests usually that can talk to something related to self-direction. Obviously, today is a little bit different, although Neal's going to discuss the impact that the virus might have on real estate and stocks and other areas of life as well. It's obviously one of the most important things, or say important, but things that have happened in our lifetime for many people on the call. So we're going to appreciate listening to his talk and his information here in just a few minutes. But we're very committed to this education. Like I said, we do the weekly seminars and webinars. They're always free. Make sure you check out our YouTube page, our Advanta On Demand. Just go to YouTube. Any webinar that we do, including the one we're doing today, we record and place up there for a later playback as well. If you're unfamiliar with self-directed IRAs, again, the YouTube page is a great place to go and learn much more about the basics of self-directed IRAs. I'm not talking about that at all today. I want to reserve as much time as possible for Neal to talk and share with us his topic. But again, most people who haven't heard of self-directed IRAs, it's because their brokerage firm that they're currently with isn't offering them the ability to diversify into truly alternative assets. And that's something we do at Advanta. In addition to real estate, here's a list of different real estate assets that we hold here at Advanta: the single-family homes, rentals, condos, mobile homes, syndications, multifamily property, and things beyond real estate as well. There's alternative assets like hedge funds, gold and silver, startup companies that you can hold inside your self-directed IRA as well. So if you have questions on those, again, my contact information was at the beginning. I'll pop it up again here at the end of Neal's presentation. Reach out to me. Again, my name's Scott Maurer. I'm with Advanta IRA. But I wanted to reserve the rest of today's webinar for Neal to present on the topic today regarding the coronavirus. I would encourage anyone who has a question during the webinar. There's a question box on the screen and in the go-to and your that you can type any questions you have. Unfortunately, we can't take live questions. There's just too many people on this webinar, which is great. But if you have any questions for myself or for Neal, get them typed in the question box. We'll do our best to get to those questions as we go along. So Neal, how are you doing today?
Fantastic. It's great to be back on the webinar, Scott, especially, on a topic that's so top of mind for just about everybody at this point in time. And so right before we let people into the webinar, I was telling you that I feel like I've given up my job as a multifamily, investor, and kind of become a pro bono, COVID researcher. And actually, around March 15th, built a website called coronavirusrealestate.com. And the goal of that website was to provide a huge amount of information on the impact of coronavirus for real estate. But then a few days later, we realized that was a very myopic approach. And so we started adding information on life, business, stocks. We started basically adding as much information as we could about the impact of this extraordinary event. I mean, this is the most powerful black swan in modern history, Scott. So ready to get started whenever you give me the word.
Yeah, no, I appreciate you coming back on. And some of the people who've been on before have recognized you. We had you on actually back in January, just a few months ago, to talk about the real estate outlook and trends for 2020. And we'd done that in 2019.
Yep.
So when you approached us and said, hey, I have obviously this topic, which again, extremely timely, very important. I mean, you can't go anywhere and do anything without this, being impacted by this. And it's, as you said, it's an extraordinary event. So I'm going to turn things over to you. And again, if anyone who has questions, please type them into the question box. And Neal, I might pop in every now and then to ask you one of those questions that shows up, but I'll let you take it away.
Sounds good. I do encourage questions beyond the scope of this presentation. If you want to talk about anything from hyperinflation to what the Fed is doing, to what the government is doing, to where you think we're going to be in 6 months, 9 months, or 5 years, feel free to pop that into the chat box. This is my 7th version of this presentation. You can imagine the amount of interest there is. The 7th version of this presentation in 14 days. So we've dealt with all of those questions. So feel free to go a little bit off topic. So there's two things that I'm going to address today. You see this question down here on the right. Could this black swan event bring the US to its knees? And when I'm talking about that, I'm talking not just about the loss of life, but I'm talking about the impact on business and real estate and stocks and the general economy. And today I'm going to give you a much more definitive answer. Sorry. Whoops, sorry. Incoming call, so my mic jumped out for a second there. So today I'm going to give you a much more definitive answer than I did when I presented this for the first time on the 18th of March. There's so much more data that has come in the last 15 days that we can give you a much better answer. So a little bit about me. I'm the guy who is super relieved that I have no investments in the stock market or in hotels or airlines in particular. I live on the quiet little apartment real estate side of the pond, where the investment is not as sexy or as addictive as the stock market or startups. But boy, I'm really happy today to be the slow and steady turtle, not the speedy rabbit. So here's some of our apartments in self-storage communities. And when I look at this sort of portfolio today, I really thank myself for being in an industry where I have the cash flow to cushion the sharp pain that we are all about to experience or have already been experiencing. So we've been checking our community's cash flow, and many of them can pay a year of mortgage even if their rents fall more than 50%. So this gives me a tremendous sense of relief that when we as a company ignored high-flying stock markets that seem to go up 30% a year without any effort, and instead invested in boring public storages and apartments, I think we did the right thing. We made the right call, and our 500 plus investors are sleeping well at night, knowing that our tenants still need a roof over their head. And our early results in April in terms of rents being paid have already validated that. So the good news is I don't have to go through the most boring slide of my presentation because Scott took care of that, right? So do not invest your money on a recommendation alone. Consult a professional advisor. So this is an educational recording only. All right, so our presentation, this is one of those presentations where entire sections of the presentations have become irrelevant. So here we should talk about some of the things about coronavirus that people didn't know about 15 days ago. But today it seems that the public is actually much better educated. So we've jumped the first 19 slides of our presentation to, to impact on your life. So here we talk about the lockdown, how long it could last, what is the data telling us today, and what was it telling us 15 days ago. So there's a huge difference there. And then this, of course, is no longer a question, right? So this question now in the last week has been answered. The US economy is now in a recession. So we're going to talk about how deep a recession, right? Could this be a 2-month, a 6-month, a 12-month recession? And then what does that recession mean for the economy? And what does the $2 trillion stimulus package mean, specifically when it comes to real estate, but also when it comes to stocks and bonds and other industries? So we're going to start off with real estate, and then we're going to talk about the absolutely devastating impact on hotels and the Airbnb business. I mean, the real estate industry has not suffered equally. We're going to talk about the devastating impact on the senior housing market and the impact on the student housing market. And then we will finish off with, a few comments about stocks. I'm not a stock guy, but there's no doubt in my mind that this presentation would be incomplete without pointing out some of the things that are happening in the stock markets. And then if we have time, we can talk about, I know that a lot of you are real estate investors. So some tips about how do you protect your community or your communities? How do you protect, if you've got other investors in your projects, how do you, protect them? What are the best practices of asset management and being a landlord in the US today? So we'll talk about that for a minute or two. So the first question that everyone has been asking, and you think about it, I mean, I'm a business person, you know how much I'm hurting because of this, right? So obviously there's an extremely negative impact on someone like me and my investors. So all of my investors, the first question they say is, Neal, you're a data-driven guy, you're a data scientist. Is a full lockdown actually necessary? Or is this all just a big hype? Well, here's my first slide, okay? And every day my slides change. So here's this first slide, which shows here in yellow, this is the United States, right? So you see this is the curve, the famous curve that we now all know about. And you notice that not everyone's dealing with it the same way, right? So you look at Singapore and Japan doing a really good job. You look at South Korea doing a phenomenal job and have not locked down their economy. The Japanese are now looking at doing a lockdown starting tomorrow. And then you've got this cluster of economies that did poorly, right? So France and Iran and Italy and somewhere in here, even though it's not named, is Spain. But then you look at China, which really had nothing to go back on. They had no data, and then of course their curve flattened to zero. And you notice that other than China, the United States had the fastest growth rate in the world. None of these other lines are anywhere close to us. So when we started out, we did an absolutely piss poor job of slowing this down, which is why we had to get more aggressive. Here's another look at it, right? This is the worldwide infection dashboard, and I updated it this morning. So it has numbers until midnight last night. So here's the United States, and you see our infection count numbers, and then you see all the other countries, some of which we've been bashing as doing a bad job. So we've been saying in our media that Italy is doing a poor job. Well, they've got half the infections that we have. We've been saying Iran's doing a poor job. They've got a fifth of the infections that we have. No other country actually in this list, and these are the countries that our media has been talking about, have anywhere near our infection count. But this number is not important. This number is all important. Look at the infection rate in Iran. They have 5% new cases every day. So the virus has a daily growth rate of 5%. Italy is now down to 4.5%. If Spain's at 8%, South Korea magically at 1%. I mean, whatever the heck these guys are eating, we need to start eating it immediately, because this is just astonishing. Even France, which started after us, and Germany, which started after us with some of what they're doing, their infection growth rates are much, much lower than ours. We are at triple Italy's infection growth rate. And this is the last 5 days. Keep in mind, all of the last 5 days, most of the US has been in lockdown. And we're still at triple Italy's daily growth rate.
Hey, so, Neal, if I can interrupt you, somebody had a good question on that slide though. Kind of how does that take into account population? Because obviously total cases is one thing. You have populations much bigger in one country than another, but it's the growth rate though is what you're saying Is that
It's the
related
growth
to,
rate, right? So
that does take into account population?
correct. So the bar on the right takes population into account. The bar on the left does not. So the US is actually doing fairly well for every million units of population. But people dying are still people dying. If we end up, just because we have 328 million people and Italy is much smaller, yes, there isn't an apples to apples comparison there. So you're absolutely right, right? So how do we do an apples to apples comparison? Well, we look at the growth rate. And as you can see, our growth rate is still, after lockdown, the worst in the world for major economies. And that is a huge concern. Now, we've obviously done something different from what everyone else has done, right? So Italy first locked down the area of Lombardy, which is North Italy, and then they locked down the whole country. And then every other country on that chart on the previous slide did a full lockdown. They locked down their whole country. We've not done that. Now, the graphic on the left is not fully updated. A few other states in here have turned blue. Today, almost 300 million Americans are in lockdown, and we've gone into lockdown starting the 20th of March. So that's when California went into lockdown. Where I live, the San Francisco Bay Area, we went into lockdown, or shelter in place, as we like to call it, on the 16th, right? So we had 4 days in advance, and I'm very glad that we did that, because now today we have data coming out of the San Francisco Bay Area, and we know that even 4 days makes an enormous difference. The San Francisco Bay Area has the lowest occurrence of cases in the US as of yesterday. And why? Because it was 4 or 5 days ahead of the rest of California, which was maybe 4 or 5, 10 days ahead of the rest of the US, right? So at this point, out of our population of roughly 328 million people, 300 million people will be on lockdown by the end of the day today. So some of the states are going into lockdown today. So I updated this graphic this morning before this presentation. And even the 20 states that are not in lockdown, of those states, there are certain counties and certain cities that have already gone into lockdown. So I'm going to make my first prediction, and you're going to see exactly why in the next slide. There are 20 states left. All 20 will go into lockdown or shelter in place within 5 days. Today being April 3rd, by the 8th of April, every single state in the United States is going to be in this lockdown. So send me an email later. Let me know if I was wrong on that. So here's the interesting thing about infection rates. This is the United States infection rate growth, our daily growth rate. So you notice that I was going to Atlanta on March 1st, and I was in a plane with Anna Myers, my VP, and I told her, you know, there's 75 cases in the United States today, and I told her that by the end of the month, by March 31st, the United States will have 150,000 cases. And she looked at me and said, I think you're completely insane. I mean, she looked at me like I was a total idiot. And she said, how could you possibly know that there's going to be 150,000 cases when there's only 75 today? And I said, I'm simply looking at China's graph, and I'm doing what is known as exponential math. And exponential math is very difficult for human beings, because the way we think is 1, 2, 3, 4, 5. The way this virus thinks, though, it thinks 1, 10, 100, 1,000, 10,000. So in the same time that it takes human beings to get from 1 to 5, the virus gets from 1 to 10,000, right? In other events, I've said that if this is the Earth of the Avengers, this virus is Thanos, because Thanos killed half of humanity in the Avengers, and this virus is capable of almost an equivalent level of disruption. Why? Because it thinks in exponential time. Look at how quickly things move. Even right here on March 16th, we were only at what, 6,000 cases? And then yesterday we were at 245,000. When the hockey curve graph moves up, things move so quickly that human beings cannot react to it that quickly. So our average daily growth rate in March was 29%. Now here's what I want to tell you. Even now, I believe that you're not able to see this correctly. So you see this hockey curve thing going, right? Now imagine what would happen if this 29% growth rate was still 29% at the end of April. So here it says April 1, April 2. Imagine I extend this graph by another 28 days. What do you think our infection count would then have been at the end of April? Well, as it happens, that would have meant that almost 2/3 of Americans would have been infected, not by April 30th, but by April 26th. 2/3 infected. So that's about 200 million Americans infected, of which normally you would see a 1% fatality rate. So 2 million people would die. The problem is, by at that 29% growth rate, we would have overwhelmed our healthcare facilities in only 10 days. By April 10th, April 11th, we would have overwhelmed our healthcare facilities. And what we've seen is every place in the US, every place in the world where the healthcare facilities are overwhelmed, we see a 5% death rate. Iran, Spain, Italy, all have seen 5% death rates because their healthcare system is overwhelmed, so they can't provide appropriate care to people, and there's high levels of infection among the infected or reinfection, and so that kills a lot more people. So we were basically on track to get to roughly 5 million Americans dead. And you might say, well, yeah, it's like the flu, blah, 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 people die all the time. The point is, I've seen studies on what happens if 5 million Americans die. And the economic impact of that is massively worse, hugely worse, like 100x worse than what we are seeing today. So that wasn't an option. So even though people like me were dragged kicking and screaming towards this thought process, when I, as a data scientist, look at this data, here's the first thing that occurs to me. We never had a choice. We never had a choice. The only choice that we had was a question of when, not if. There wasn't an if between lockdown versus no lockdown, because losing 2 million to 10 million people, the economic impact of that, leave the deaths aside, leave the human aspect aside, the economic impact of losing 2 to 10 million Americans would devastate our economy for decades. There was no option. The only option was a when, and our president has chosen to give each state that option because of our federal system. And so as I said, 30 states have already done it. A whole bunch of other cities inside the other 20 states have done it. And I believe in 5 days, we will be in a total lockdown. Now, when I started doing this presentation, it was highly, highly depressing because of this particular slide. On March 22nd, this slide is a March 22nd slide. I'm going to show you this slide as of today. This is where the US was, and this is where Italy was. And really, really depressing slide on that day. And I had a message of hope that day that is much stronger today. So here was the United States daily growth rate, right? And as you can see from this line, if you look closely, it is accelerating. The daily growth rate as of March 22nd, this is March 22nd right here, accelerating. And as I told you, if you continue to allow this to accelerate, at the end of April, 2 to 10 million Americans are going to die. Now take a look at Italy. This is Italy. Look at the blue line, and you notice that their growth rate started kind of like ours, like 36%. So it was very similar to ours. Actually, it was a little bit higher than ours on March 1st. Then they went into lockdown, and look at where they are today, right? Now I want to show you how much has changed just since March 22nd, right? This graph, this snapshot at the end, at midnight, March 22nd. Now watch what happens today, 10 days later. Identical. The US's daily growth rate since March 22nd, when we started to do shelter in place in more and more cities, and there was already some social distancing in effect. But the moment we actually went supernova on this, look at how much difference 10 days makes. We are on the same exact downward path as Italy. And when I move this path forward at an exponential level, my numbers are actually much more bullish than Dr. Fauci's. In my mind, and obviously they have to be careful because they're making public statements. They don't want to be wrong. They don't want people to start moving out of their houses. But luckily, I only have 100 people on this webinar, so I can just give you the unvarnished truth. Right now, the math looks phenomenally good for the US to reopen, partially reopen. Some things cannot be reopened, like domestic travel can't be reopened, international travel can't be reopened. But things like restaurants, in my mind, this math shows me will reopen sometime in May, maybe early May, maybe late May. But the good news is, look at the difference we've made in just 9 days. Phenomenal, isn't it?
Hey, Neal, I had a couple quick questions that came up and they're talking. I think people are going back a little bit to the especially to the rates and whatnot, is kind of, do you believe that some of this is contributed? I guess the differences between countries, like you said, you were saying like Iran and China.
Mhm.
Is it any, how much did the availability of testing and also the accuracy of reporting have to do with some of those numbers? I think that's kind of the great unknown, what's behind the wall in China, as far as what the actual numbers might be. But
Yeah,
as our rates in the U.S. a reflection of that, because we were starting to get a greater access to the testing?
well, here's the good news. What we've realized by looking at the data, looking at the data science for the last 10 or 15 days is it didn't end up mattering. So a lot of people believe that the rate of testing was mattered, and early on it did, right? So if we had done what South Korea did early on, did, rapid testing, we would have saved tens of thousands of lives, right? That didn't happen. So, it's a shame it didn't happen. But today, the rate of testing doesn't matter because we are already seeing daily infection rates go down, right? So, if you say, well, yeah, we're not testing enough and we actually have a lot more people, then why does the daily rate of infection go down every single day, right? So the number of people that actually are coming in for testing is going down while our ability to test people is going up. So it doesn't matter. This data still correlates today, regardless of how much testing Italy and the US do at this point in time, because we're in the sixth inning of the ball game here. Today, we don't have a lot of questions about testing. We did have a lot of questions here, right? On March 22nd, we were speculating, oh my God, these numbers are different because of testing. It turns out, no, it wasn't because of testing. The numbers changed because of the lockdown. Because clearly, even as more tests became available in the US, our actual daily growth numbers went down. They should have gone up. If we were not testing enough and there were a lot of these millions of people in the population that were not, that were actually infected but not tested, this would have spiked upwards. It didn't spike upwards, it spiked downwards, which showed that what really mattered was the hammer. I call this the hammer and the dance. And somebody wrote a wonderful article about this in Medium magazine that you should definitely read. What we are in, and we started this right around March 22nd, right around here, we started what is known as the hammer phase, right? Where we basically use lockdowns, and Italy has been using the hammer since about March 2nd, March 3rd, right, to drive this down. And our goal is to basically drive this down to zero and get it to the point where there's negative growth. So there's less cases every day. And then what we start is known as the dance phase. And in the dance phase, we know that the virus is not eliminated. We know that the virus is around in our communities. And what we're doing is we're opening the US, seeing it flare up in certain areas, shut those areas down without shutting the rest of our economies down. So the dance phase looks more like a hurricane, right? So when a hurricane happens and it hits Houston or it hits Miami, it doesn't shut down the rest of the US. It doesn't shut down the rest of our economy. So what we're going to be doing is doing these shutdowns of certain parts of the economy in the second half of May, all of June, and all of July, I think, until we get more of a control on it. So my message for you is, no, the testing rate is not as relevant anymore because of this, because of what we saw in the last 9 or 10 days. We can do absolute apples to apples comparison between US, Italy, France, Germany, Spain, and even China. China is a kind of an odd case out because we truly don't know if they reported their numbers correctly. So when we were doing our math, we just ignored China. We could not trust their numbers, and we still don't trust their numbers. So
And Neal, follow up on it. Just someone was asking, when you talk about lockdown in your analysis, are you including kind of the states that are doing like work from home or shelter in place orders? I mean, kind of those
yes,
terms, I get, they're kind of, I guess, somewhat interchangeable when we have that discussion.
we do. So I mean, in the US, in a democracy, I don't think that it is possible for us to do the kind of lockdown that India is doing, where they have a siren that goes off and people come out for 3 hours and then they have to go back inside and they beat you with sticks. It's not going to happen. Here's the good news. Do you think it's necessary? Look at the green line. It's not needed. What we're doing, what we call shelter in place or safer at home, is really all that's needed. It clearly is having a massive impact just in 9 days.
And one more quick question before you move on. Someone asked if, because they're saying right now, I guess the person who's asking the question is saying that they're saying only 50% of the results from the tests have come in. And I guess they're asking, if you only have 50% of the data, is that accounted for in the analysis with the statistics? So if you only, you have 100 tests out there, but you only have 50 results back, how do you account for the not having the other 50 test results back?
The short answer is the rate. So here, if you have 50% less results here where my mouse cursor is, and then the next day you have 50% less, and then the next day you have 50% less, it all averages out, doesn't it? Because the daily rate on each of those days when we didn't have 100% of the data still dropped. This is why the daily rate, the percentage of daily growth, matters more than counting the actual number of tests. Because if you count the actual number of tests, you're going to be really depressed, because here's what it looks like. Every day looks like this. And you're looking at this going, oh my God, we're all going to hell. No, because every single day, that daily rate is dropping. And that is all that matters, because when you can have an imperfect number of testing, but if you continuously have the daily rate dropping, as you can clearly see it is, then we're continuously having a significant impact. Even if we had 50% of the results here when we were at 39 and 50% of the results here at 14, it actually cancels itself out. That's what data science says. All right, so moving on to money matters, right? So we talked about the human aspects of this. Let's talk about how deep this recession is going to be. And the folks at Green Street Advisors, for instance, they were one of the first, and to their credit, to warn that the economic impact will be massive. And people, it will be massive. So this whole concept, and maybe I can take a pen here and draw on here. All right. So you've heard of this already. You've heard that we could have a 2008 type recession, which is kind of like this, and it sort of goes down like this, and then at some point it sort of builds up like that, right? So that's 2008. Or we could have something known as a V recession, which is a very, very sharp recession. We've already seen this part here, by the way, right? So this is a V. And then as soon as you get to the point where you reopen the economy, you get this, okay? Now, while this makes sense, it's nonsensical, because the damage that we've done to the world economy to save ourselves, to save 2 million to 10 million people in the US and 100 million people outside of the US, that damage means that this all the way up is unlikely. So today, based on the data that I'm seeing today, here's what is more likely. Watch this. Down, 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 down. And this may not go as far as we thought. So it might actually go maybe here. Then watch it go up, but then it stops. Why? Because of all that damage. That damage has been done, that it prevents it from going all the way up here. So this is likely. So, and with this point being about 3 years from today, because it will take a long time for us to mitigate some of the permanent damage that we've done to both the world economy and the US economy. I don't know what to call this. I certainly can't call it a V, because obviously a V would keep going up this way. But this is what is very likely to happen at this point. We see a sharp uptick, but then at some point it stops, and then it slows down, and then we get slow growth over the next 3 years. We could also see a downturn here, and then another recovery here. So we because obviously there's a lot of damage that's been done here. So those are the options that we're looking at today. We are certainly not looking at sharp down, then stay here, and then sharp back up. What people call a U is less and less likely based on the data that I'm seeing today. All right. So Goldman Sachs then started to warn, and they even initially said that we would have a 5% reduction in GDP. It's amazing how quickly this virus moves because of its exponential nature, where Goldman Sachs issues a warning saying we're going to lose 5% of Q2 GDP. And then a week later, Goldman Sachs issues this warning, minus 24%. If nothing tells you how devastating this virus is, this number should. Goldman Sachs, these people are not idiots. They're really, really smart. They went from 5% to 24% in a week. That's how quickly things are moving. Now, just so you understand what this number means, the third quarter of 2008 was negative 8%. And that's about as much of a decline as we've ever seen in one quarter of GDP. So according to Goldman, we're going to be 3 times sharper than Q3 of 2008 when the shit hit the fan there. And Morgan Stanley thinks it's going to be 30% of Q2 GDP. We've already crossed this number, 9%. I mean, once again, amazing how things move so quickly. Last week, this was a projection. Today, it's reality. We're already at 10% unemployed in the U.S. today, and I think that the number that Morgan Stanley has, 12.8%, is more likely, or it could be even higher. So we've looked at the last 2 weeks, right? So this is the initial jobless claims in the U.S., and you kind of see where those numbers are. And even if I take those numbers back to like the 1980s, the highest we've ever had is 600,000 people in 1 week. 600,000 people. It was in 1982, and so the week before we had 3.3 million people, and that's right here. And then last week we had another 6 million. So now we've got 9.9 million job losses in the US in the last 2 weeks. So we've already gone to somewhere around 9 or 10% from 3.5%. I mean, the virus is making a mockery of all of our economic models, a total and complete mockery, right? 18% of all households in the entire country are impacted by layoffs. I expect this number to go up to about 23% in a week, in 1 week. And then we've got 18 million jobs impacted. Once again, that number is going to go up to about 23, 24 million jobs. And then we have industries that don't exist today. The restaurant industry has gone from, this is OpenTable's reservation system, has gone from basically being business as usual on the 1st of March to being not existing as an industry on the 19th of March. So in 19 days, the restaurant industry went from being normal to simply not existing. There is no restaurant industry in the US at this point in time, except there's obviously significant takeout volume, but there is the industry as far as open doors are concerned really doesn't exist. And it's only one of industries that's hurt. The hospitality industry is absolutely crushed. Retail chains are crushed. Small businesses, mall operators. My gym, I pay $200 a month for a gym that has 6 people in a group, and their revenue has gone to zero because people like me had clauses in our contracts allowing us to simply pause our memberships. And so they went from having 200 people paying them $225 a month, so 45 grand a month, to having $0 a month, right? So nothing like this has ever happened. Oil is getting crushed. There's talk of oil dropping to $10 a barrel. Yesterday it was at $21 a barrel, which by itself is an outrageous number, right? Oil was at 80 bucks a barrel. This is what I mean by you cannot just have a V-shaped recovery, because a lot of oil producers are already filing for bankruptcy. So we had one file yesterday, one file today. A lot of this doesn't come back. The capex that they were putting in, the billions of dollars of capex, has now gone to zero, and it'll take us a number of years to move up. Car producers have seen a 80% decline in the last week of March. Rideshare companies have seen massive declines in revenue. All theme parks are closed. So that there's certain industries that are not impacted. This word impacted sucks. I'm going to take that off. Certain industries are absolutely decimated or devastated in a way that we've never seen before in a recession. And that's why this guy, James Bullard, who's the president and CEO of the Federal Reserve Bank of St. Louis, says, and this is the worst case scenario, he pointed that out, US unemployment could be at 30% next quarter. The last time we saw that, 1929. GDP could plunge as much as 50% in Q2. This one, I think he's walked it back to more like 30%. He said he was being a little bit too bullish, but still these numbers are unheard of. Nothing in history compares. So here's a likely scenario, the road ahead. And the scenario on the left was where the US was 10 days ago. So keep in mind how far we've come. On March 22nd, this scenario was bullish. That was that we try containment and care, that the US did not do what other countries did, lockdown. 10 days ago, only California and one more state, I can't remember, Washington, were in an actual shelter in place or lockdown. And in this scenario, 40 to 70% of our population gets infected, 2.4 million Americans die. Today, April 3rd, we are at large percentage of the US in quarantine, with me saying 5 days from now, the entire country will be in quarantine. And then instead of 2.5 million Americans dying or 8 million dying, that was the kind of the worst case scenario here, we're now looking at 50 to 100,000 deaths. And I know Dr. Fauci is talking about 100 to 240,000 deaths, but I think the data now suggests that we'll get significantly less than that. Let's talk about the impact. On the left, we were looking at financial Armageddon. the deepest depression we've ever seen. All real estate would have been illiquid. The stock market would have dropped to below 10,000 points. What we are dealing with now is that bounce back in Q4, right, that we've been talking about. But remember, this is very important: down, partially up, and then slow recovery, with this being 3 years from today. That's much more likely than what a lot of people have been suggesting, overly bullish. This type of recovery is extraordinarily difficult today because of the damage that we are doing to the world economy. It's a planned damage, but it's still happening. So, as you can see, when I designed this presentation, there was a big question there, right? And I think this question is now answered by U.S. governors, essentially shutting down the country one state at a time. So this question really does not matter at all. So even 9 days out, my presentation is parts of it are becoming invalid. So let's talk about the aid package in history. I think most of you know this: $250 billion for individuals and families. That money has started to come in. Interestingly enough, one tenant in one of our properties has actually received the money already through ACH, which I was stunned by, because today is only April 2nd, and the Treasury was saying that even people who have direct deposit into their bank accounts wouldn't get it before the 12th of April. So I'm happy to see how quickly this money has started to flow in. And I have to say that real estate, especially landlords, are the biggest beneficiaries of this. So I like to tell people, and this is a little bit tongue in cheek, but I tell people today, when people receive this money, first, they're going to buy food with it. Second, used to be rent, right, in the past, but of course today it's Netflix. So it goes food, then Netflix, then rent. So luckily Netflix is only $10 a month. They're going to pay their Netflix account, and then they're going to basically pay money towards rent. And that's what we've seen in the last 2 days. There was a lot of prediction of gloom and doom in the apartment industry over which tenants would pay and which tenants would not pay. Only 2 days have passed, so it's very early. But I have to say that our bearish, our most bearish projections have not come true. So we do have communities with significantly higher delinquency levels, but it is a manageable level so far. That's what we've seen at our 2,000 apartment units. So the lending program will help hotels and airlines, but will not help cruise lines. So that's an area that's going to be very distressed. A lot of national security businesses. This is a very key portion, because small business loans, if they keep workers, so my gym is applying for that small business loan. So am I, because my apartment communities, if you think about them, are small businesses, right? Every apartment community that I buy is a small business. It has less than 500 employees. So we're also making sure that we get both loans and grants. There's a $10,000 grant, and then there's loans for our employees that are at these properties. Clearly, we're going to have more delinquency, so we are eligible. Even though I have to say, compared to the retail industry, compared to the hotel industry and the airline industry, I mean, our distress is minuscule, right? So at this point, March, we had no impact. We had $0 of impact at any of our communities in March. On the good side, our notice to vacates all got taken back. So when people are leaving our communities, they're moving away. 30 days before, they give us an NTV, or notice to vacates. All of our NTVs, people eventually came back and said, I don't want to move in the middle of this. And so nobody's moving. So our occupancy is actually frozen at right around 95%, which is delightful. So we haven't lost any occupancy at any of our properties. We haven't had anybody move out or leave. So, student loans are deferred for 6 months, so they've got some options there. And then there's a lot of protection, right? So people with mortgages get 60-day forbearance. The multifamily guys get 90 days. So our lenders are open to doing 90 days for extensions. And we haven't filed for extensions because we simply don't have any proof of damage so far. And then there's no evictions or failure to pay rent for 120 days. Now, what's important is this last bullet is that you can still damage the resident's credit. There's nothing against you filing for them not paying, and we've let our tenants know that, look, this still goes on your credits. And so a lot of those people have come back to us and said, well, we're waiting for our checks to come in for Treasury. Can we pay late? Sure, you can. Can we pay a portion of our rent from deposits, from our security deposits? Sure, you can. So we're helping people as much as we can. but we're telling them, giving them this consistent message that rent is still due, rent is not forgiven in any way, and our tenants are listening.
Hey, Neal, I had a quick question on that because it's something I saw that same thing the other day and was wondering just your thoughts on. Do you think that when that 120 days is over, assuming there's no extensions, do you think we're going to see a much higher an eviction rate spike? That people who, landlords out there who haven't been getting paid for 120 days just simply say, okay, now that I can file an eviction notice, I'm going to go ahead and do so.
I think it will happen. I completely agree. There's going to be people who will take advantage of the system. There's going to be people who are going to say, you know what, I'm just not going to pay rent even though I am getting a salary, right? So today you have a choice. Number one, you are still employed. Well, you can choose to pay rent or not. Number two, you were laid off, but then you received all this money from the government, but you're choosing to just pocket that money and not pay rent. Number three, your company ended up taking part in this program here on the left, right? So they took part of this program and they're required to keep workers. So they hired you back on, they started paying you a salary, but now you're like, well, I can't be evicted. So there are going to be some people who don't care about their credit. There are going to be people who don't care about the fact that they'll have an eviction, black mark 120 days from now. So we are going to see a spike, no doubt about it. Absolutely, there's going to be a spike, and we've seen some tenants already move in the direction of, this is a 4-month rent holiday, and we've let them know we're going to keep filing the eviction process. We cannot get you out of the property. We understand that. No sheriff is going to come in, but we are going to queue you up for eviction. So the moment your 120 days are out, you're going to be on the street. And so a number of them backed off when they realized that. That's not all of them did. So yes, the answer is there's going to be a significant number of evictions. And by the way, this 120 days is likely to be walked back. I showed you numbers that showed that we're going to reopen the economy faster than we thought. So I think this 120 might get walked back a little bit. So because it's not a federal requirement. Keep in mind, it's only a requirement for Fannie Freddie loans, and there's lots and lots of lenders across the US where we have properties where we do not have to obey this. Did you know that? Lots of properties, because those are private lenders. Those are, local banks, and they have no requirements to meet that Fannie and Freddie have put in place. So there's many of our properties where we're telling people we are not under that 120-day sanction. All right.
Yeah,
Unemployment.
I was going to say one more quick question. I think it goes to this slide, and you may be addressing this here in a minute, so I may be asking a little too soon, but someone was a good question, said, what kind of hyperinflation or inflation do you think might come, obviously, from us printing this, basically this $2 trillion package? And this is just one aspect. I know there's another $3 or $4 trillion package that was separate.
Yep.
And how is that going to impact the real estate market? Again, if that's something you're going to cover, we'll leave it and move on. But that was a good question, I think, that just came in.
I think it's one of the most important questions, but I want to wait a few slides before I address it. But yes, I'm definitely going to address the hyperinflation question. I think you like my answer.
Okay.
So unemployment insurance, we've got 4 months of expanded jobless benefits for the self-employed and gig workers included, which is amazing. I mean, there's obviously a lot of room for misuse, but gig workers who are contract workers are included. So not only are we applying for ourselves, we're also applying for our contract workers. So there's a lot of money available. And then most importantly, $200 billion is available for healthcare. $100 billion has been sent to hospitals. Remember, the hospitals were doing everything from lip surgery to boob surgery, and they can't do any of those elective procedures anymore by law, which means that they're losing money by the truckload, especially because they're running 3 shifts a day, 24 hours a day. So there had to be money for hospitals, and so it was phenomenal. One thing I wanted to say this, and a lot of people have said this, I am very skeptical as somebody who is a business person. I'm very skeptical of the way that the government hands money out, but I have nothing but good things to say. This package, every part of it made sense. The only part of it which didn't make sense, and I live in California, I like renewable energy. It still didn't make sense not to bail out the oil industry. So I'll just leave it at that. Yes, many of us don't like the impact of oil on climate change, but to destroy an entire industry simply because of pollutants at a time like this did not make sense. The rest of it, Congress gets extremely high marks for me, both for the different pieces of this and the speed, the remarkable speed. Never in history has a $2 trillion aid package gone from not being discussed to being signed in 17 days. 17 days. The U.S. Congress for once acted in virus time. So, we've talked a little bit about this, so I'm going to skip past some of these slides. There is a real strike of rent strike. There's a real possibility of a rent strike happening. There's more people talking about a rent strike. And so I'm happy to see that we are bending the curve or flattening the curve much faster than we thought we would, because if this goes on for a month or 2 months, Twitter, this 4,603 is going to turn into 4 million, and then we end up with a massive rent strike, which causes enormous chaos in the real estate market. So far, with 4,000 people talking about it, it's no big deal. But if we don't, another reason why we had to really bend the curve, we had to be aggressive, because these sorts of things, rent strike, people just not paying for anything that they are buying, that's what leads to anarchy and chaos. So there's a little bit of a, hey, this is happening. It's beginning to get a little bit of traction from Marcus and Milicha. So I'm going to skip past a couple of these, and then I'm going to go over. By the way, these are our properties. We haven't seen an impact yet because construction is being deemed essential. So, and construction workers wear masks and gloves anyway. So they tend to work in different areas. Like there's one worker working here on the 3rd floor, and there's another person working here on the clubhouse. And so they're widely separated through a massive area that's 20 acres. So our construction properties haven't been affected, and neither have our public storage properties. The funny thing about public storage is that it's $80 a month, $70 a month, and it's, whoops, sorry about that. My phone cut out there. So it's $70 or $80 a month, and most of it is going from your checking account. And in the middle of all this chaos, nobody actually figures out that there's 70 or $80 that's going out. And would you, for $80 in the middle of all this chaos, actually go out and take all of your stuff out of public storage? So we're not seeing impact to self-storage, which is why we're extremely bullish on our self-storage investments that are coming up. And if there's anybody in this group listening that would like to learn more about upcoming self-storage projects, please reach out to me. I'm going to give you my contact information on the last slide. We strongly believe in this asset class. And by the way, you're about to see proof of why you should believe on. So once again, we've talked about a few of these, so I'm going to skip a few slides, and I'm going to go to this slide, which is a very important slide here. So here we go. So this is how all the different sectors of the real estate market are affected, right? So now this chart is a few days out of date, but the angles and the numbers still matter. So what's hit the hardest, right? So this is the hardest group, the biggest losers group here, and there's no doubt that the hardest hit is the senior housing industry right here. Why? Well, if your grandma is 90 years old and she's in a senior housing facility, and there's 200 other people in that facility, and you know that this virus, this enemy, is circulating the halls, are you going to leave your grandmother? Right? Nobody is. You're going to bring them back and have them live in your house. So we've seen a lot of senior housing facilities empty out. We've seen a lot of skilled nursing empty out. Here's my prediction. I think this group has the longest amount of damage. Why? Because I'm not going to put my grandma back in until there's a vaccine. So even when the world reopens, I'm afraid of putting my grandma back into that senior housing facility. So I think senior housing, skilled nursing takes it on the chin, and I'm hopeful that a vaccine comes in fall, not next year, because it's going to really devastate their business. They're also going to have new restrictions that will increase their expenses because they have, healthcare mandates that they will be under, that they weren't under before March. The lodging and the gaming industry is basically hotels in Las Vegas and Reno are also extraordinarily hit. These are high expense areas. They can't reduce their expenses very easily. So they're really, really hard hit. And I wouldn't be afraid that over time, if the lodging industry, this number, this minus 36%, this is the drop in value for REITs, for real estate investment trusts that are publicly traded on the stock market. So they give us a good view of what's happening. I wouldn't be surprised. Student housing is hit only temporarily because the students have left, but fall enrollment at most universities in the US is extremely robust. The students are going back. They want to go back. Most students do not consider the student housing to be temporary. They consider it to be their home. So what we are seeing is that the bounce back here on student housing could be the strongest. and also could be immediate, by the way, because there's a semester coming up in August. Malls are taking a huge hit, but not as much as strip centers. So what we're seeing with malls is that the tenants in April are still paying. Most of the tenants are paying. Some, like Cheesecake Factory, have said, nope, we're not going to pay, but most of the mall tenants are still paying. Whereas the strip center, that the individual corner strips, strip malls, almost nobody's paying. I'm actually invested as a passive investor in one in Burleson, um, Texas, and they let us know that more than 70% of their payments did not come in for the month of April. So all the nail salons, the dentists, everyone stopped paying for the moment. So that this area is very, very hard hit. And I expect this minus 24 to keep going up to 30 or 40 or 50, because it's going to, those are the least capitalized tenants. So they're the hardest hit. And so I expect that this is going to turn into a bloodbath. So if you like buying strip centers using your IRA money, you're going to see some great opportunities in Q3 and Q4. So keep some powder dry. Office is not hit as hard as we thought. And the big reason for that is a lot of office space is leased out to big companies. Big companies have lots of cash in bank. Everybody is paying. So anecdotally, we've heard that very few tenants have stopped paying in April. So it's the number of tenants that are not paying here is so much smaller than the number of tenants that are not paying here for strip centers. So this is like 4 times as high. So that's why not taking a lot of hit. Apartments took an initial hit before it became clear that the bill was going to be passed. And now this number has dropped from minus 23 to more like minus 10, which makes sense, given that people now realize that there's $2 trillion of money going to tenants, and the biggest beneficiary of that are going to be apartments. And we've seen that already. A lot of people have told us that the money that they're paying us this month, they're going to wait for that check to come in 10 days, and then they're going to pay their rent, which we're fine with. So life sciences not hit at all. Life sciences are the portion of real estate that is tied back to medical offices and research offices. Here's our prediction. Initially, everything's gone down, but this area, medical offices, does not deserve to be in the negative. Here's our prediction. Over the next 2 months, instead of seeing a negative growth in medical office, you're going to see this go this way and then be a positive growth. So in my mind, medical offices are a phenomenal buy today. Yes, there's things like social distancing and telemedicine, but in the end, people want to go see a doctor. We haven't seen a huge change in attitudes there, and it might take decades for that to change. We don't have enough medical offices in the US for a post-coronavirus world. As you've heard already, coronavirus changes the world more so than 9/11 did. This is a much bigger black swan event. And as a result, I think that there's a phenomenal investment to be made here for those of you that are in the stock market and like investing in REITs or real estate investment trusts. But I think the best option is right here. Self-storage. Take a look at this. Phenomenal, to see just how little they've dropped. And by the way, this number over the last 6 or 7 days as the stock market has recovered have kind of moved here, where there's almost no decline in REITs at all for self-storage. So incredible area, because it tends to go under the radar. Tenants will, worry about their $1,000 rent, but are they going to worry about their $70 a month storage unit? No, it's not worth the hassle. Nobody's emptying out storage units and trying to save $70 and risk being infected. So for the moment, the self-storage industry is just frozen in place, no impact at all. So I'm not going to talk about cell towers and data centers because these are very small portions of the real estate market. The one sector that wasn't here that is affected positively is industrial. So if you like industrial REITs, now may be a good time to invest, because all of the Amazon effect means that the industrial sector is likely to come out a big winner in the post-coronavirus world. I think we're going to need more logistics space. We're going to need more industrial space. We're going to need more warehouses all across the United States. So especially as businesses start to say, we need more inventory. We got hit because we only had 4 days worth of toilet paper and 6 days worth of wipes. We need to keep more storage. Businesses are going to increase the amount of storage in the US. Industrial is going to be a huge, huge winner. And
I was going to say real quick on that slide before you jump on. What about single family rentals? I don't know. Obviously, the share there is that's REIT shares, but maybe a lot of our clients, a lot of people on the call are just individual. They own 1 or 2 or 3 different rental properties. How do you see that being affected?
Very good question. I'm glad you asked me that because I sort of forgot that one. I see single family doing really well. Now, there's going to be some impact in April. There's going to be some impact in May, but we're not just talking about how much you get in rents as a landlord in April and May. You're going to get less. Some people are going to get 30% less. Some people are going to get 50% less. But the feedback is as soon as the economy reopens, I think you guys are going to overall do well. You're going to do much better than the red portion of this slide or the blue portion of this slide. And there's two reasons for that. Number one is this has been a white collar depression or recession, white collar, right? The people that got hit worked in restaurants and on cruise ships. They worked in airports. They worked in hotels. That's white collar. Oh, sorry, that's blue collar. So, sorry, blue collar. On the white collar side, the people that work for offices and companies and technology places and defense haven't been hurt as much. And so single family rentals tend to lean more towards the white collar workers who can afford higher rents. So it really depends on what kind of rentals do you have. If you've got rentals that are, let's say, $1,200, $1,300 a month, you're going to be getting hit a lot less. If you've got rentals where the tenants living in there are living in there $800 a month, you're likely to be hit a lot more. So it depends upon the type of real estate that you have. But I expect single family rentals to do well beyond May. What happens in April and May? Well, you're going to get hit. But 2 months of a rent hit is something that most landlords in the US can sustain. So I am not going to predict that there's going to be a flood of single family defaults with lots of buying opportunities in Q3. You want buying opportunities? You're going to see them here: smaller offices, strip malls, hotels. Tons of buying opportunities will come here. But I don't think that on the multifamily and the single family side, you're going to see massive opportunity in Q3. You'll see some. There'll be some price reduction in single family, some price reduction in multifamily. So think of it as a dip. Might be 5%, might be 10%, but not 20 or 30%. And certainly not the 70% reduction in some areas that we saw in 2009. That sort of impact is just not on the cards at this point in time. And then I'm going to finish. I'm going to do 2 minutes with the stock market, just food for thought. These are some of the companies that are hard hit. So for those of you that like to pick up bargains, there's some bargains in here. I can tell you what I have purchased so far. I purchased stock for Royal Caribbean at 80% off its 52-week peak. I also purchased Boeing, which is a phenomenal company and doesn't deserve its stock to be hammered as much. So again, if you think that the impact is going to last a long time, you should be dumping these stocks. If you think that the impact is not going to last for a long time, then there's some bargains in here that you might want to pick up. I certainly think that Starbucks and Walt Disney, with their amazing brands, should not see such declines in their stock prices. So those are my thoughts there. Here are some companies that are direct beneficiaries. So short-term beneficiaries are obviously people like Costco and CVS and Kellogg's and P&G. We're seeing gun stocks have a phenomenal month or quarter. We've seen incredible sales, so they might have a blowout year. So if you like dividends, you might want to look into gun stocks. And then long-term beneficiaries are people like DoorDash and Grubhub, delivery services, right? People like Gilead that make vaccines. Gaming companies like Zynga and Activision and Akamai are seeing stock increases. We've all heard about Zoom. It's kind of the poster child. So obviously that I'm not sure if there's a deal to be made there, but Slack could see a huge increase and its stock hasn't gone up a lot. But to me, I think some of these here, Grubhub and DoorDash, are really terrific companies to look at. And then again, if you don't have issues with the human aspects of it, I think gun stocks could be terrific to take a look at. And then we've run out of time here, so we're not going to talk about what we're doing at our communities. We can do that in questions. Here's my email address, and this is very important. For those of you interested in looking at what we are doing with our projects, because we've got a number of, we call them corona-resistant projects that we've changed our pipeline a great deal in the last 20 days. We've dumped a bunch of projects, and we've gone to projects that we think are highly corona-resistant. And if you'd like to learn more about them, I'm not allowed to get access to your webinar, enrollment information, but you can certainly send an email to me and I'd be happy to tell you more about those things. And now I'm happy to take your questions.
Yeah, Neal, great job. We did have a couple of questions coming. I'd advise anyone who's still on, we've still got a ton of people on the webinar. If you have other questions, type them into the question box. We'll get them answered. I think one question,
I'll do the hyperinflation one.
Yeah, So we had to ask about the hyperinflation with the $2 trillion. What impact do you think that's going to have then on real estate and I guess the economy in general going forward?
Well, let me answer the question the most straightforward way possible. 2008 taught us a lot about the way hyperinflation works. There's going to be hyperinflation when we do, $4.5 trillion worth of money printing by the Fed, $700 billion worth of bailouts. None of those things happen. Here's what economists have learned. Here's how things have changed. Hyperinflation is unlikely to happen in weak economies. Weak economies do not create inflation. Weak economies do not create hyperinflation. We're going to have a weak economy for the next 2 or 3 years. So any hyperinflation that may come out of this comes at the end of 3 years. In the end, we all know that printing money has long-term impact, but I do not believe that there is a short-term impact. 3 years out, who knows? It could be quite significant, or it may not happen, right? The economy in 2019 was booming. 2018, it was booming. So did we see hyperinflation then? No. We were running trillion-dollar deficits in 2019. Did we see hyperinflation then? No. So the chances of seeing hyperinflation in 2020 in a recession year, in a sharp recession year, are extraordinarily low, in my opinion.
The other quick question, I held it to the end. I wasn't sure if you get to it or not, but I thought it was a good question asked at the time when we were talking about the growth rate of the virus. Any charts, any stats out there on kind of when these lockdowns start to become relaxed, whether that happens towards the end of this month or the end of May or whatnot? Are we going to expect to see maybe the growth rate increase again? Or are we going to see like a lot of kind of bumps along the road, or kind of what are your thoughts on that?
Yeah,
as people get back out and try to restart the economy a little bit.
That's the hard one, and we're going to have to be very clever about it. I can tell you that's the tough one, because the hammer, which is the phase that we are in, I think ends at the end of May, right? We go into the dance, and the dance is tricky because you and the virus are dancing together. You know it's there, you know it's not dead, but you have to act like it is while being careful and not having flare-ups. The good news is China is showing us the way. So at this point, China is in the dance. Their economy is open, Apple stores are open, malls are open, people are shopping. And still, the virus is circulating in China. They have new cases, a few new cases every single day. So they have to change things. We're going to learn a lot from them. We're going to learn a lot from Italy, which is going to go into the dance a month before us. So the answer is, we don't have data yet, but we will, because we are not the first or the second country to go into the dance. We're going to start using apps. So you're going to start seeing government apps come up by the end of May that we can opt into. That'll show you if there are people that have been infected close to you. And those apps will be very useful for us to very quickly contain the virus. So the way that this virus works is we get case, cluster, cluster, boom, right? So New York right now is boom, New Jersey is boom. The point is that when you get to a cluster, you immediately have to lock that area down, that small area, just like New York locked down a town called Rochelle, I believe, and not let it go into the boom phase, which unfortunately ended up happening in New York. So the point is, we are learning, and we're going to use our technology and our abilities to learn over the next 2 or 3 months how to do the dance better. There's no data yet, but I expect us to do better than most people think.
Yeah, and Neal, I want to thank you again for coming on today. I mean, again, Neal's contact information's on this slide, and I think what Neal, I'd like to probably do then is revisit, obviously in a couple months, having you back on and taking a look back at what we've seen. We're trying to prognosticate and look forward, but have you back in a couple months to, kind of see ultimately what some of the impact is, and then what we, obviously what you, like you said, this presentation's changed in 10 days, and we can only imagine what's going to happen in the next month or two as well. To give us that idea. So yeah, we'd love to definitely have you back.
Fantastic. I'd like to do that because I think this is a unique Learning. I've never. I mean, in a weird sort of way, I enjoyed putting this together because there's so many aha moments in these slides, more so than anything else that I've ever done. Because a lot of my stuff, that the slides are all about real estate, but this was really all about math and how that math is going to help us get through this, so we can get back to the path of buying real estate and buying stocks and enjoying the benefits of the economy. So I'd love to be back on. I'd say probably in 45 days, because by that time we will be at the beginning of the dance.
Yep, and yeah, Neal, we'll look forward to having you back on. So again, everyone, we'll send your contact information out. We send a recording link out to everybody who registered as well. So make sure they have your phone number and your email to ask any other questions. And again, if anyone has any questions for the IRA side of things, here's my information. You can always get that at our website at advantaira.com. But Neal, thank you again very much for coming on today.
Thanks so much, Scott, and have a nice day, everyone. Stay safe.
Thanks. You too. All right, thank you.